the first step of the day is to think like an auditor. It's good as we go into this process of creating policies and procedures to get a good understanding of what your auditors are concerned with. So with that being said, I've listed a few of the assertions that auditors are concerned with when they start the audit process. You'll see on the far right, we have completeness, valuation, classification, rights and obligation. There are more, but we're just going to focus on a few today. But the main goal for your auditors during the audit process is to obtain reasonable assurance about whether financial statements as a whole are free from material misstatements, whether due to fraud or error. Now, when it comes to ASC 42, they're going to want to seek to understand the steps that you have taken to mitigate the risk of fraud due to error, due to error or fraud. So we're going to talk through some of those procedures and policies today, but when it comes to these assertions, we have completeness. So what completeness is we're trying to confirm that we've accurately captured all of our leases and that they are properly stated on our balance sheet. So auditors are going to want to look at the policies, your procedures that you follow to ensure that you have a complete set of leases. Next is valuation. So are the calculations correct? Are your calculations correct? Now, there are a few things that go into your calculations when it comes to your lease liability and right of use assets. Number one is your payment streams. Number two is your lease term. Number three is your discount rate. So auditors are going to spend some time ensuring that these components agree to the contract and have evidence to support them. And then finally, classification. So under the new lease accounting standard, all of the operating leases that were, used to be off balance sheet items are now going onto the balance sheet. When it comes to classifying leases, you have operating, finance, and you also have short-term leases, and they're accounted for differently. So you want to ensure when classifying leases that you have, good policies, good procedures in place that your auditors can review and that you can refer back to when going through these processes to ensure that your leases are properly classified. All right, so for the next section of the webinar, we're going to focus on transition risk. And really the goal here is to make sure that our procedures are robust enough to ensure that we've captured all of our leases, that the data is accurate and the calculations are correct. And then after that section, we'll talk about disclosures or quantitative and qualitative disclosures. Now, the question is, have you captured all your leases? That's a great question. And what procedures have you performed to reduce the risk of not finding all of your leases? That's our goal here. So I would like to mention that these procedures will be included in your initial gathering plan. But as Sarah mentioned, you want to keep in mind that you'll want to have procedures in place to ensure that your organization captures new leases on an ongoing basis, so nothing slips through the cracks when you're gathering new leases. Now, we're going to focus on the initial gathering, but a lot of this can go hand in hand, so you can use these on an ongoing basis. Not having these documented will definitely result in your auditors spending extra time performing additional procedures to ensure that your lease population is complete. So I'm going to focus on a few procedures that could be performed. Again, this isn't all inclusive, but these types of procedures can help ensure that you've captured or have a complete list of your lease portfolio. So first step, as we mentioned earlier, we've engaged all departments in the process. They know what to do. They've been educated on what embedded leases are, what terms of leases, things of that nature are. So we're going to send out a lease listing to all of those departments involved. They're going to fill out all the requested information and then send it back to us. Once we have that lease listing, we're also going to request all the contracts from those departments so we can compare the lease listing to the contracts we have. One comparison or analyzation is, you want to see if, do I have a contract for all of the leases listed in my lease listing? And do I have a lease listed in my lease listing, that's a tongue twister, for all of the contracts that I have been given by the other departments? One thing I'll suggest as you're going through these procedures is that you're saving your documentation and the work you've gone through when creating, ensuring that you have a complete listing. Auditors would love to have this to ensure, you have corroborating evidence that you actually performed these procedures. So that's the first step. Next is to request a list of recurring payments from your AP team. So all of your recurring payments, and then compare that to your lease listing. So do you have all of the recurring payments listed in that schedule listed in your lease listing? Compare the two and see if you need to go back to the department to see if there are other leases missing from your lease listing. Finally, or the next section we'll talk about is comparing your final lease listing that we've created and gathered from each department, comparing that to our 5-year lease commitment schedule. So, prior to 842, you've disclosed your 5-year lease commitment schedule. You could compare your total lease cost from your lease listing to your 5-year commitment schedule to see if you're missing anything. So if your 5-year commitment schedule is higher, you may not have all of your leases listed in your lease listing, and vice versa. If you find that your lease listing is higher than your 5-year lease schedule that you've historically created, you may have found some embedded leases or new leases that you weren't accounting for. Another procedure is to extrapolate all of your annual rent expense and your lease listing. So you'll take your total extrapolated lease payments from your lease listing and compare that to your total rent expense from your GL. How do they compare? If you have your rent expense that's larger than your lease listing extrapolated amount, then that may indicate you've missed some leases, and vice versa. If your lease listing is higher, there may be some embedded leases and things of that nature. So just comparing the two will help you get an idea of if you're missing leases or you're finding new leases. One tip I'll give you is that it doesn't have to reconcile exactly, but reconciling directionally or in the ballpark can help you understand whether all of your leases have been captured. Again, I want to emphasize all of this work that we're performing, we're going to document the steps that we've gone through so that our auditors can review that. And it's also something that we can follow at a later date, or our team can look at to refer to what type of procedures they need to perform when they're collecting lease information, and have all of that data or that information or that work documented so auditors can review and confirm that you actually did the work that you said you did. Next is the data abstracted from the contracts complete, or is it accurate? So here, the main thing is, if you look at the contracts, is the information that you listed in your Excel document or in the software that you're using, is it accurate? One thing that I would recommend doing is when you're collecting all the lease data and sending out lease listings to your departments, have one person collect all the lease data and populate the Excel document that you're using to collect the information, and then have another person review it. So that can help, confirm some accuracy there if there was any errors or anything like that during the collection process. So that can help to ensure that the data is accurate from the contracts. And then finally, are the lease calculations correct? So the three components, or there's a few components that go into the lease calculations for your lease liability and right of use asset. Number one is the lease term. For the lease term, we've talked about this, previously. It's not just as simple as looking at your start and end date, but you have renewal options, termination options, purchase options that you'll have to consider if they're reasonably certain, because they'll impact your lease term. So you want to have policies in place to ensure that your employees are analyzing the contracts, and if the options are reasonably certain based on your policies, that are accounting for those correctly. Lease payments, on the surface, that seems fairly simple. However, there's some complex factors that can impact lease payments and your lease liability and right of use asset. Number one is lease incentives, determining what are contractual minimum lease payments, residual value guarantees and finance leases, any payments made prior to the start of the lease, so like prepayments. Those are all going to impact your lease liability, or each one of those is going to impact either your lease liability and right of use asset. So when analyzing your lease payments, have procedures in place to state how you followed your procedures to determine that these lease payments are correct, and we followed our policies in determining that. So documenting all of this clearly so your auditors know how to audit your lease portfolio. And then finally, your discount rates. This is huge in calculating the lease liability and right of use asset. Under the standard, lessees are required to use the implicit rate if it's readily determinable. However, it's quite complex to figure out all of the assumptions that the lessor is using when determining the implicit rate. So if you can't find the implicit rate, you have the option to use the incremental borrowing rate, which ASC 842 defines as the rate of interest that a lessee would have to pay to borrow on a collateralized basis over a similar term and at an amount equal to the lease payments in a similar economic environment. So it sounds, a little complex. Are we able to determine all of that information and coming up with the IVR? If so, you just want to ensure that the processes and procedures that you go through are repeatable when determining what IBR is and being able to document that so your auditors can review it and so you can review it when creating IBRs for leases that start at later dates and things of that nature. Now, considering the IBR is also complex, and as we mentioned earlier, the standard setters have given us the risk-free practical expedient where we're able to use the risk-free rate found on the Treasury website. Easy to find, easy to audit. We've mentioned the caveats involved with that. Whatever rate you've decided to go with or you decide to go with, just ensure that you've documented your reasoning and the source documents and calculations for the rates you've decided to use so auditors can gain comfort for your decisions and the rationale and the logic you used in creating those discount rates. All right, so finally, this is the last section of today's webinar is disclosures. So really, have you disclosed everything necessary? That's the goal. You know, as with all accounting standards or changes, the entities must provide required disclosures as part of their financial statements. Under ASC 842, or financial disclosures in general enable users of financial statements to assess the amount, timing, and uncertainty of cash flows arising from leases. Accordingly, disclosures, both quantitative and qualitative, are intended to supplement the amounts in the financial statements, so the balance sheet and income statement. So auditors are going to want to evaluate the accuracy of those disclosures based on their understanding of your company's activities. So it's important to develop processes to ensure that you've captured all of the correct, quantitative and qualitative disclosures. And one great way to do that is to develop a disclosure checklist. So we have a lot of articles at leasequery.com where you can, look at the required disclosures, but go through all of the required disclosures, both quantitative and qualitative, create a checklist, and then you can have one person, go through, prepare the disclosures, they'll check off the checklist, and then maybe have someone to review to ensure everything has been disclosed properly. That's a procedure that can be documented and followed on an annual basis to ensure that you disclose all of the correct disclosures.